Hello, my name's Charles Lastic. I'm the Managing Director of Blue Bond Tax Planning. We've been helping clients avoid inheritance tax for more than 18 years. And this video is around how inheritance tax is actually calculated. Okay, so how is inheritance tax calculated? Well, very simply, let's work first of all on a single person. So a single person or divorced person, when they die, the tax is immediately payable and depending upon the value of their assets. Now, if the total value of their assets exceed 325,000, then tax is payable because the first 325,000 at the time of speaking anyway in 2021 is a nil rate band allowance which isn't taxable. You then, if you own a main residence which you pass to immediate descendants, children, grandchildren, adopted children, then you get a further allowance of 175,000 called the residential nil rate band. So when you add both of those together, you get an allowance of £500,000, and that is non-taxable. Everything else is taxable at 40%. However, it's not quite as simple as that. You get allowances of £3,000 per year that you can make as gifts, and if when you die you've not used your allowance, your solicitors who are helping you with probate should claim the £3,000 in that year and possibly also the £3,000 in the previous year. So you can get an extra £6,000 if you've not made any gifts during lifetime. There's also the anomaly that if you've made gifts in the previous 7 years directly, those gifts are brought back into your estate and those would be regarded as potentially exempt transfers. Now, if you've made gifts that exceed the nil rate band of 325,000, after 4 years you would get something called taper relief, which is a 10% reduction in the tax. So after 4 years you get 10% reduction on the excess over the 325, and then in year 5 you get a 20, and so on and so forth. So it's not that straightforward a calculation, to be honest. And also, where most people are looking at calculating their inheritance tax, you've also got to determine, right, well, if you're trying to say what would my inheritance tax be likely to be, then you've also got to project it forward, the value of your assets growing over time. If you look at our website, there is a good calculator which helps work that out and also does the projections going forward. Now, if there's a married couple, if they leave their allowances to the surviving spouse, then again, there would be no tax to pay, and then the surviving spouse can claim those allowances in the future. Now, if the nil rate band of 325 grows, and if the residential nil rate band grows, then the increase in the allowance can also be claimed by the surviving spouse, and it depends upon the date at when they die as to whether it's claimed or it isn't. However, there is something that one can do to significantly save some inheritance tax if there's likely to be a big gap between husband and wife dying. This is by taking the value of the property, 325,000, their main residence, and dropping it into a trust on first death. Now, most lawyers won't think to do that because they think, well, the surviving spouse has got the full allowance anyway. Why would you do that? The reason is the allowance has been frozen for about 10 years. It's frozen until 2026. Who's to say it won't be frozen from there on afterwards, right? Especially with the issues in the government coffers with regards to, COVID and the debts that the country has built up. So by putting 325,000 into a trust, the growth on that property value then grows outside of the surviving spouse's estate. And if you say a property grows at about 3.5% a year, 325,000 times 3.5% is about 11,400. 40% saving on that is about £4,550. So for every year there is a gap between husband and wife dying, there is a potential saving there of £4,500, which obviously if it's 10 years can be 45,000. There is also an additional reduction in the value of the main residence for inheritance tax purposes on the second death of 10%. So this is an accounting principle which basically says who owns the property on second death. This is the trust on the one hand and the surviving spouse on the other hand. And because two separate legal entities own that property, the value in the surviving spouse's estate is reduced by 10%, right? So if you've got £1 million property, when the second spouse dies, that's 10% of that is 100,000, 40% of that is 40,000. So when you add up that 40,000 along with maybe another 40,000 for the gap between husband and wife dying, you can see there can be quite a significant saving by doing some planning outside the norm. If you want to understand how this works, please call and talk to us. We offer a free meeting for people. And yeah, give us a call and we'll see how we can help. Thanks for listening and bye for now. Bye.